Last year, I made a decision I honestly didn't expect to make. I switched my KiwiSaver from Milford to Kernel. Now, before anyone starts sharpening their keyboards, this isn't a video about why Milford is bad, because it isn't. I actually have a lot of respect for what they've built, and when I first chose them, I had my reasons. So, what's changed? As it turns out, quite a lot. The interesting part is that over the past few years, the way I think about investing has changed quite a bit. I've spent hundreds of hours researching investing for this channel, all trying to answer one simple question. What's most likely to leave me with the biggest nest egg by retirement? The more I learned, the more I realized that if I was going to tell thousands of Kiwis how I think about investing, my own KiwiSaver needed to reflect that thinking as well. So here's exactly what I'm going to show you in this video. Why I made the switch, what stood out to me about Kernel, how surprisingly easy the transfer process was, and after moving my KiwiSaver, a few things I discovered about Kernel that I wasn't expecting, but which fit perfectly with the way I now invest. Whether you are happy with your current provider, or you've been meaning to review your KiwiSaver for years, my goal isn't to convince you to switch. It's to show you the thinking behind my decision, because according to the Retirement Commission, more than 800,000 Kiwis don't even know what fund they're invested in. If this video gets a few more people to spend an hour reviewing one of the biggest financial decisions they'll ever make, then this video will have been well worth making. Kernel did support me in making this video, but the thoughts are completely my own. When I first signed up for KiwiSaver, I did the typical thing. I was interning at ANZ in my first ever job. I filled out a couple forms, and from that point forward, I was a part of KiwiSaver. My default fund was the ANZ Growth Fund, and after a couple years, I then switched to the Milford Active Growth Fund. At the time, it made a lot of sense, because Milford was an active portfolio manager, and I believed their team with impressive credentials would be something of a market whisperer and could consistently pick winning stocks. For anyone new to this, there are two types of KiwiSaver funds: active and passive. Active funds try to outperform the market by having professional fund managers choose which stocks to buy and which ones to sell. Passive funds simply aim to track the market as cheaply as possible through an index. Because active funds employ investment teams, they generally charge higher management fees. And this difference in fees is what really caught my attention. With Milford, I was paying around 1.25% a year for an actively managed fund. Kernel's High Growth Fund, on the other hand, charges just 0.25% a year. That's roughly 5 times cheaper. Now, 1% doesn't sound like much, but here's what it could mean for you. Let's say you have a $50,000 KiwiSaver balance. If we compare Kernel's management fee to the average for an aggressive KiwiSaver fund, that's roughly $300 a year staying in your account instead of going towards fees. Now, over a working career, that could compound into tens of thousands of dollars. Of course, the argument for active management is that those higher fees are meant to be offset by higher returns. By charging 1% more, they'd need to consistently outperform by 1% or more before I'm actually any better off. So I started looking at the evidence. One of the biggest studies on this is the S&P Global SPIVA scorecard, which compares active managers against passive benchmarks over time. Looking at global equity funds, which are the closest comparable asset class to most growth KiwiSaver funds, over 91% of actively managed funds in New Zealand underperformed their benchmark over 3, 5, 10, and 15 years. In Australia, it was over 82%, and the United States tells a very similar story. Now, that's not to say that active managers can't outperform. Some absolutely do. I just wasn't confident I could reliably pick which managers would keep outperforming decade after decade. That's ultimately why my investing philosophy shifted towards low-cost passive investing. But this wasn't the only realization that caused me to switch. It also comes down to how KiwiSaver has changed itself. 12 years ago, there wasn't nearly as many low-cost passive options as there are today. Most of the big providers were banks or actively managed funds, so the choice felt a lot narrower. If we fast forward to today, the landscape looks completely different. There are more providers, more competition, and far better access to globally diversified index funds at a much lower fee. There are funds with Bitcoin, with property, individual stocks, venture capital, and plenty of others. Now, I'm not saying these options are right for everyone, but the amount of choice is vastly greater than when I first signed up. By this point, I'd become convinced that passive investing was the approach I wanted to take for my retirement savings. And once I'd reached that conclusion, choosing a provider became much easier. The question wasn't, should I switch? It was which provider best reflects the way I now think about investing. And for me, that ended up being Kernel. If you haven't heard of Kernel before, let me fill you in. Kernel is a 100% Kiwi-owned investment company with more than $4.7 billion invested on behalf behalf of over 60,000 Kiwis. Over the past few years, their name has been popping up a lot more often in investing circles. I've personally been investing with them outside of KiwiSaver since October 2021, so I already knew the platform, I'd used many of their funds, and I've been watching them grow for many years now. It also meant I wasn't switching into something completely unfamiliar. I was simply bringing my KiwiSaver into line with the rest of my investment portfolio. That familiarity gave me confidence, but it wasn't the reason I switched. The reason I switched was because Kernel happened to line up almost perfectly with the investing philosophy and habits I've gradually developed over the last couple years. The first reason I switched is fees. Earlier we talked about why fees matter, and here we're talking about just 0.25% a year. So by switching, my fees became a lot lower. With another 30 to 40 years till retirement, this is one of the few things that I can control when determining my long-term returns. The second reason is simplicity. Every single payday, I'm already investing into Kernel's investment funds, so with KiwiSaver alongside this, it keeps all my long-term savings side by side. Their dashboard was recently refreshed, making it even easier to navigate and track how everything's going. The third reason is flexibility. Kernel gives me a lot of options to structure my KiwiSaver exactly how I want to. Out of the box, they have 4 basic funds: Cash Plus, Conservative, Balanced, and High Growth. But for the more advanced players, you can pick your own selections from Kernel's full lineup, including property funds, ESG funds, New Zealand funds, even a hedged version of the S&P 500. So there's a whole lot to choose from. Right now, I'm in the High Growth Fund, and it has a 98% concentration in growth assets, so it's optimized for my time horizon of 30 plus years. So I get the simplicity, the flexibility, all in a relatively low fee package. The fourth thing that gave me confidence is performance, relative to all the other KiwiSaver funds. Morningstar compare all the KiwiSaver funds each year to see which ones had the highest returns. In the latest June report, over 3 years, Kernel topped the tables for their balanced and high growth funds and came second with their cash fund. Importantly, Morningstar measures returns after fees have already been deducted, so these are the returns that members actually received. Now, does that guarantee they'll be top of the table over the next 3 years? Of course not. Past performance is never a guarantee of future returns. But for me, it was reassuring to see them at the top. After spending so much time researching the evidence behind low-cost passive investing, it was encouraging to see that philosophy also delivering strong, real-world results over recent years, especially against their actively managed peers. So when I added everything together, it wasn't one thing that convinced me. It was the combination of low fees, broad diversification, a simple investment philosophy, a platform I'd already trusted for nearly 5 years, and a provider that seemed completely aligned with the way I now think about investing. At that point, switching my KiwiSaver actually felt like the obvious decision. A question that many of you are probably thinking is, how difficult was it to switch providers? It sounds hard, but actually, it was surprisingly straightforward. All I had to do was go to Kernel's website, create an account, and fill out an application form with my personal details and initial fund selection. And that was pretty much it. From there, Kernel handled the transfer with Milford directly. I didn't have to ring anyone, follow up, send an email, or negotiate with anybody. It was a set and forget process. I completed the form on October 27th, 2025 and received confirmation telling me to sit back and relax. After about a week, they sent me an email just letting me know that things were moving along. And then on November 9th, my balance had been fully moved across after 13 days. Basically, Milford had to sell my investments, send the money over to Kernel, and they had to invest that money into my new funds, so that's why it takes a little while. It's also important to highlight that there weren't any fees for changing providers, but you might just have to check this with your provider first, just in case. But all in all, it was a pretty easy process, and after I filled in the forms, my work was pretty much done. Then I just had to log into my Kernel dashboard, and my KiwiSaver balance was sitting there already set up. One thing I realized after switching over to Kernel was that I actually started interacting with the platform a little bit differently. The auto invest feature helped me stay consistent with my investments outside of KiwiSaver. Every payday, I send money across and they invest it automatically on my behalf. I don't have to think about it. I set it up once by telling them how much, how often, and what funds, and they do all the rest for me in the background. If you have some spare cash lying around too for shorter term savings goals, their savings accounts might help you earn a better return than the bank. You can move funds in and out in just a couple business days, so it's easy to move money around as and when you need it. The Pi fund is a wee bit different, as depending on your income, there could be some tax benefits, so it's nice to have this option to get more bang for your buck. One final thing I came across was Kernel Plus. If you are using the platform a lot, it can actually reduce the fees you pay across your investment account and gives you access to a few extra features like Pi Save and the Total World Fund. Again, it wasn't a deciding factor for me, but it's a nice option to have as your investments grow. None of these factors individually made me move my KiwiSaver. They were just nice bonuses that I appreciated more once everything was in the same ecosystem. Many people leave their KiwiSaver with the banks because it's easy. But with Kernel, they offer a better interest rate on savings accounts. Their KiwiSaver has topped the recent Morningstar rankings, and it all sits in a single app alongside your low-cost index funds as well. So these days, I think the conversation is starting to change, and the innovation from Kiwi fintechs like Kernel are becoming much more convenient, with everything being managed from a single app. At the start of this video, I said the person who chose Milford back then isn't the same investor making this decision today. Looking back, I don't think either decision was wrong. They were simply the right decisions for where I was at the time. Today, Kernel is the provider that best reflects the way that I think about investing, and that's ultimately why I made the switch. As always, make sure you do your own research and choose the provider that's right for your own goals and circumstances. So if you'd like to give Kernel a try, you can check them out using my link down below in the video description. And if you have any further questions about why I switched or how to use Kernel, let me know down below in the comments. If you enjoyed this video, please make sure to give it a thumbs up and subscribe. I've posted over 300 videos helping Kiwis manage their money and grow their wealth. So don't forget to subscribe, and I look forward to catching you on the next one. Cheers.